Good afternoon on July 30th. This is Jim Perry with the weekly Perry Capital podcast. Welcome. It's been another week packed with market information, economic information, and political intrigue and confusion in Washington. Let's get right to it. We have 5 issues we want to talk about today. What caused the market gyrations? How sound is the economy? What is the Perry Capital investment outlook? What could go wrong? And what's in the week ahead. Fast-moving times, volatile times. Our mission is to provide independent, objective, accurate information that you can use to make investment decisions right now. So let's get going. Thank you. Okay, so why the gyrations in the stock market? I think the place you start is recognizing where we are. First of all, the highs in the stock market were on July 10th. They have rallied since October of last year. The S&P 500 is up about 38% during that move. It's down 4 cents. The NASDAQ was up about 75%. That's down about 9%. And NVIDIA, the torch bearer of the Olympics, if you will, was up 275% and is now down 26% since then. Huge rise from the lows, tremendous valuations, concentration of returns in a small number of stocks, growing nervousness about earnings coming up this week and next week with NVIDIA, and no wonder that the VIX is as high as it is. So what's the trigger here? Why did all of this stuff sort of start happening? You got to start with politics. The volatility and intrigue and confusion in Washington. I'm not sure anybody's seen it any greater in this country, and the rest of the world is looking on astonished. Trump survives an assassination attempt. Then he goes to the Republican National Convention in Milwaukee. His odds of winning the presidency go up at one point last week, 2-1 against Biden. And then, of course, Biden's out and Kamala is in. Those odds have now balanced out. They'll probably stay pretty balanced and maybe go in Kamala's favor as we enter the Democratic National Convention on August 19th in Chicago. And earnings, everybody wants earnings better. They're coming in a little bit weaker, and that's keeping new money from coming back into the market. So all of a sudden, this whole momentum rally that we've had has lost a bit of a momentum and speed. So the other thing that happened, and it's really important, is that the dollar-yen pair has really shifted. The Bank of Japan came in and bought Japanese yen for dollars. They sold dollars, and that FX pair moved by 5%. And that's a lot in the FX market. A lot of people don't look at it, but the quant guys do. And when the quant guys see the dollar going down that hard, there is a correlation between a lower dollar and risk assets. And the NASDAQ tracked the dollar down almost every time the Japanese did their interventions. They did 3. So the NASDAQ doesn't like a lower dollar, and that's setting a stage which we're going to have to look at very carefully in the quarter ahead. Thank you. I just talked about stock prices. Stock prices are related to earnings, and earnings are related to the economy. So let's talk about the economy. GDP in Q2 rose at 2.8%. That's up from 1.4% in the first quarter, twice as much as most people thought. We kind of felt it was going to be about that number because we saw that business investment, which was strong, and consumer spending, which was strong, hadn't dropped back a little bit. And they have. Consumption was well over 50% of the GDP number, and business investment on the fixed side was almost 0.75 of a percentage point. So that's good. Question is, now that we are in Fed blackout period, the Fed will be talking tomorrow. They will not cut tomorrow. We don't have to worry about rate cuts or rate changes until September 18th. But the issue is inflation. Inflation. Households, it's the number one issue, and they really want it to go down. Trouble is, it's not going down. CPI is running at 3%. Some of the metrics are smaller, and a lot of economists on Wall Street, especially Wall Street economists and at the government, are convinced that we're going to get down to trend very quickly. I'm not so sure. I think there's a lot of service inflation out there. I think wage inflation is still a problem. I think the labor force is a lot bigger than people think it is. We've already known that it's as big, it's bigger than it was pre-pandemic. So I think inflation's stickier than most people think. I know I'm in a minority. I guess my biggest issue is that financial conditions really are much more stimulative than the Fed is saying. They're not restrictive at all. And in fact, financial conditions are easier today than they were when the Fed funds rate was at 0%. So I think Mr. Powell should think a little bit more about households rather than the major shareholders of the Federal Reserve, the big banks. Okay, so what is the outlook for investors between now and, say, the election? I always say, if you know what I own, you know what I think. I put my Perry Capital portfolio in the weekly strategy piece for my institutional investors every week. It's there for all to see. 50% of my portfolio is essentially cash. That's mixed between T-bills that are paying 5.35 and a 2-year kind of money market account that's trading at about 5%. I would much rather have cash than a treasury bond because I am of the opinion that inflation is going to be worse than expected and is actually worse than expected. But a lot of people disagree with me and think I'm being too conservative. On the other side of the coin, my 40% position in the stock market has been going very, very well because it is in the area that the economy is doing very well and the returns are doing very well, which is big cap tech. And that's where the growth is. So I think people should stay there. Yes, it's getting a hit right now. So what? It's earnings season. They're too expensive anyway, right? If they get a little cheaper here, maybe another 5 or 10%, I'm going to buy more. Because I still think that the government's going to probably come in and stimulate the economy a little bit more if it needs it, and it might, before the election. If I was a Democratic candidate for president and my party controlled the government and I had the option to spend more money before the election and after, I'd spend it before. And I think that's what's going to happen. So we'll see, but I'll let you know as the weeks unfold. Okay, in the last section of this podcast, I told you I'd be happy to allocate more capital to the stock market if it got cheaper. So between now and the election, what gets the stock market cheaper? I can think of 3 risks, really. The first one is political risk. I think the chaos in Washington is perceived by friend and foe alike overseas as very negative. I think the idea that Biden was forced out and Kamala was all of a sudden placed in, and Trump doesn't really know who he's running against yet. And there was no debate, there was no discussion, there was no voting, there was no anything. So I think international investors see that. They look at this country much more negatively and much more chaotically. And we have to remember that international cash flows into this country since the pandemic have been absolutely enormous. And they have been a huge portion of the support in the stock market that we've seen for the last 3 or 4 years. If that stops, the valuation of the stock market goes down. And the quickest way to stop it is to calm down all this nonsense in Washington. And I'm not sure that's going to happen yet. So that, I think, is probably the biggest risk. After that, it's earnings season. Let's face it, we're in the middle of it. The big cap tech stocks, they have driven earnings growth and the performance in the stock market. Nothing's going to change that. I think we will know more when NVIDIA reports its earnings. That stock was up 275% from the October lows up till July 10th. We need to see big cap tech stocks still making money and spending money. And if that slows down, the market's going to go lower. After that, really, it's at rising unemployment. We're at 4.1%. The Fed thought it would be at 5.5% by now. Last year, when Fed funds were at this level, they're not. They're at 4.1, which is pretty good. If unemployment goes up and people spend less, consumer spending, which is over 50% of GDP, will go down. I think that's a risk too. So we're watching them closely, and when we see some changes that are important, we will let you know. Thanks a lot.